Swayam Prabha. Digital India. Educated India.
Hi all, welcome to the next session on commodity derivatives and risk management. And without summarizing what I discussed in the previous session, let's start the today's session with the futures understanding of the futures contracts, traded futures contract at CME. If you recall, we discussed about the variety of futures and options contract available at CME. We also discussed about futures contract specification, crude oil futures contract specification at CME, and futures contract available at MCX. So now the MCX market will be open, so I thought of spending a couple of minutes showing you how this Indian commodity derivative exchanges inform about current happenings at the commodity derivatives trading through their website. So let's go to this website and focus more on what is happening at the crude oil market, crude oil futures market. So if you can see this, okay, so this is so you have aluminum contract trading, cardamom, copper, okay. So let's go to the, yes, so now focus on this one. You please say this one, crude oil. If you can see, so standing here on 24th June, you have 19 July contract which is maturing on 19th July trading. At what price it opened? When the exchange opened, it traded at 3,360 rupees a barrel, and it has this is your open low LTP and high close. So you have, this is your open price for today, 3,206 is your low price, and 3,251 is the last traded price, and the highest price throughout the day is 3,360. So open price is also the highest price, and this is your close price, that is yesterday close price, the price at which this particular contract closed yesterday. So this is yesterday's close price. So compared to yesterday's close, this current price 3,251 is 104 rupees difference, and this is in percentage term, it comes to minus 3.10. and what is the number of contracts? Let me see, yes, how many lots have traded today? 1,44,100 is the lots which has traded. Now the next contract is August contract. Similarly, you have 8,779 September contract, October contract traded. Let's see whether November December contract trades or not. Let's go to the next page. So you have, yes, you have November and December contracts also trading today, but the volume is very low. Only 3 contracts since morning has traded and 4 contracts are traded. There is also another contract called crude oil M, that is mini contract. So everything is same, only the lot size will be lesser. So this on this date again you will have July, August, September, October, November, December. So all contracts are traded today, but the maximum trading happens in the nearby contract. So 1,73,454 lots have traded, so and so forth. So this is, So what I am driving at this point of time, or what is the key takeaway from this discussion, is that in India crude oil contracts have maximum duration of 6 months. So a company which is using the exchange platform will be able to mitigate the price risk only for 6 months. Now let's go to the there are some data which I have downloaded from the Bloomberg. I thought of discussing this. If you can see, this is the WTI NYMEX crude oil futures contract, which traded on 22nd June 2016. So if you see, this is the nearby contract. August 16 is nearby contract, and it has gone up to, as we discussed, it has gone up to December 2014. Of course, I don't have the volume traded. This normally some near month contracts will have a higher volume traded compared to the far month contracts. But the fact that the price is available means yesterday, day before yesterday, all these contracts have traded. So on June 2016. 22nd June 2016, contracts maturing in August 2016 to contracts maturing on December 2014 has traded. And let's analyze this curve. This curve, if you can see, it is a contango curve. So subsequent price, that is far month future price, is higher than the near month future price. So this is the observation based on the commodity forward curve prevailing, crude oil forward curve prevailing for WTI on 22nd June. Now let's go to gasoline curve, forward curve. Very interesting curve. Similarly, like you have gasoline is nothing but your petrol. In India we call it as a petrol. There is also, again, I had asked some of you what is the full form of RBOB with respect to soybean oil. There is also an RBOB here, so I hope you will be able to tell me. Let me ask the same question: what is the full form of RBOB here? Okay, now let's focus on what are the futures contract available on 6th June 2016. This is the date on which I downloaded. If you say July contract is available, and it has gone up to maximum duration of it has gone up to January 2020. So 4 years into future, the contracts for 4 years into the future is available. And just the interesting part about this future contract commodity forward curve is a beautiful sequential kind of a curve. So very up and down, and it's very, very clearly this kind of a data. Whenever we see this kind of data, we know that this underlying data series has significant amount of seasonality. So you remember we have discussed about how do we go ahead and calculate the seasonality index. So I just did some basic calculation, and let's focus on the seasonality index for different month. So let me make this value little bigger. So if you see, please ignore this value. This is the interim value. Let's focus on the last column F. Detail given is the column F. So you have July, August, September with a seasonal index of 1.987. You also have April, May, June. You have a seasonal index of 1.11, and if you say the other months, seasonal index is hovering around 0.95 to 0.99. So going by that, the 6 months have a higher prices, and this rest of the 6 months have low prices. Why this will happen, we will be discussing about it. So you have the answer to RBOB I have mentioned here. So the full form of RBOB is reformulated gasoline blend stock for oxygen blending. So this is the full form of RBOB. Now let's go to heating oil forward curve. So what is a heating oil? So this it's a refined product predominantly used for heating homes and commercial buildings and all that. So it is, if you see, it has gone up to, again it has also gone up to January 2020, and this is the forward curve for heating oil. And another very interesting forward curve with a clear cut seasonality. You have natural gas futures curve, and if you see, this is very interesting. It has gone up to December 2028. So buyers and sellers have taken exposure in futures contract 12 years from today. So from 2016 June to December 2028 is the contract. And if you know, I have just plotted this forward curve, and this shows a very clear seasonality, and I have also similarly have calculated the seasonality. And as you can see, you have please ignore this column D as the interim calculation value. So you have July, you have December, January and February are high seasonal months. So during this period of time, you have prices ruling high compared to the other months. Similarly, let's do some analysis whether WTI futures price normally have contango or backwardation structure. So let me increase this size a little bit so that it will be visible for you. So what have I done is, from the Bloomberg, I have downloaded the data for the August contract, that is M2 contract, and I have downloaded the spot price prevailing on all these days, and I have calculated the basis, and based on that I have found out whether it is a contango or backwardation. If you see, for subsequent substantial point of time, it is a contango market in 2016. It shifted to backwardation market sometime around or it is other way around, from a backwardation market around November 2014, it has shifted to the contango market subsequently. So from 15th, in fact from 20th November 2014 onwards, the market is crude oil, WTI crude oil futures market is exhibiting contango. Okay, now let's go to our understanding about whether Indian market, whether it is contango or backwardation. So unlike US market, where you have a prolonged period of contango or backwardation, in Indian case it has been mixed. It is contango some period, backwardation some period, so on and so forth. So this is similarly in India, at a multi-commodity exchange, you have not only the crude oil derivative contracts trade, you also have natural gas futures contract trade. This particular worksheet shows the relationship between the spot as well as the nearby futures contract, and like your crude oil, this also exhibits contango backwardation intermittently. So there is no specific trade of contango or backwardation in Indian market. Okay, one thing also interestingly I would like to share with you all. I just mentioned in last session that US shale oil production has gone up, and this is also visible in the available ending stock inventory of crude oil. So you have, if you can see, during this data is from January 2000. If you see how the US ending stock of crude oil million barrels, this data I have downloaded from US Energy Intelligence Administration website. So if you can see how the barrels, how the storage amount, crude oil storage amount, ending inventory has gone up year on year. So now focusing our attention on what has been the experience of Indian companies which are exposed to crude oil price, or Indian companies which are exposed to refined product price. How do they hedge this price risk? Unfortunately, when I was doing web search to find out from the annual reports of these companies, how do they hedge, not much of information is available, bearing one or two companies. So one of the very prominent commodity price risk hedger in Indian market with respect to crude oil and crude oil derivative has been Reliance. So if you see this particular block which is in front of you, so this is the Reliance commodity hedge for the financial year 2014, and for hedging commodity related risk, this is what I have exactly done, cut and paste from the annual report. So this detail shows the as of March 2015 in comparison to March 2014, what are the different kinds of contracts Reliance has undertaken for mitigating the commodity price risk. They have entered into forward swaps, they have entered into futures, spreads and options, and this is the only company which is, to my knowledge, this is the only company which is making this information available. And in fact, almost all Indian companies they have one section in the annual report with respect to the how they are mitigating their foreign currency risk. So the foreign currency gain, foreign currency loss, and what instruments they have used to mitigate the foreign currency risk, that is very well documented and given elaborated properly. But I'm not sure whether companies are doing this commodity hedging and not informing, or companies are not doing. That information is not clear. Also, the accounting requirement, the prevailing gap, generally accepted accounting principle requirement, does not mandate a company to give the commodity derivatives, commodity hedging they are doing. That could be the reason why companies are not informing or not giving this information in the annual report, even if they are doing commodity hedging. So that aspect is not very clear. But in this context, I wanted to share another interesting development with respect to Air India. As per this, different reports, Press Trust, Information Press Trust India, this particular report, Air India hedged 10,000 barrels of jet fuel for its aircraft. This particular report was dated on October 16, 2013. This article, though it has been published by Economic Times, but original information has come from the Press Trust of India. So I want you to spend 1 minute understanding this. Let me read this one. In a bid to slash cost, Air India has hedged 10,000 barrels of jet fuel for its aircraft this month, 4 weeks after its board gave a nod to the move. So, quote unquote, we have started fuel hedging and have hedged 10,000 barrels for delivery this month. We are closely following the Brent trading and plan to hedge at $110 a barrel, airline sources said here today. So also another interesting thing, this is the first time hedging was undertaken by the national carrier in several years. So what I am driving here is that this is the first time a company which is perceived to be little laid back and known for not taking many new initiatives. That's what my perception, and again, as I said, let's not make this one another forum for discussing about the performance of airlines. So that's not our agenda. So but what I am what I appreciate about that a company which is perceived to be little slow and laid back, they have taken a very big leap in terms of their risk management policy, and have entered into the mitigating the crude ETF turbine fuel price risk by entering into the hedge. And if some of you will be focusing on it or analyzing it in detail, you may not agree with the information given here that they have hedged this crude ETF at a price of $110 a barrel when the Brent was quoting at $110 a barrel. But one thing I would like to mention here is that is what hedge is all about. So you anticipate that the price is going to go up or go down, and accordingly you would take a decision, and in the hindsight probably this decision would be proving not so good. I won't use the word wrong, it should not be proving good at this point of time, considering the crude oil price has gone down. But let's consider a case had it been other way around, that is, the crude oil price if crude oil prices would have gone up to $175 or $160, then it would have been given a substantial benefit to the Air India. Of course, at this point of time, even if Air India is paying maybe incurring loss by entering into this kind of a futures contract at a very high price, it is benefiting from a lesser crude oil price prevailing or lesser ETF price prevailing at this point of time. So hedging is all about stabilizing your cash flow. So if you are gaining in your physical market operation, you will invariably end up losing in your futures position, and vice versa. So personally, I feel that it is a very commendable effort on part of Air India to have a stated policy of risk management and formulate a committee which will look into it, and they have gone ahead, and subsequent reports also web search gave that Air India is hedging 2 million barrels of aviation turbine fuel annually to take advantage of the lower crude oil price. This particular report was published on January 19, 2015. So this was reported by Live Mint. So this link is also given. So the essence of all this discussion is that not many Indian companies have entered into different kinds of derivative contracts to mitigate their energy price risk. If at all, if they are doing something, they must have done a long-term forward contract, which is not available. And also another aspect, considering most of these companies are under government control and public sector entities, probably they have their own limitations in terms of having a commodity derivative hedging desk. So maybe time has come that other companies will be following suit and have their own board policies and start taking initiatives on mitigating their energy price risk, because volatility in crude oil price and the refined product price is going to be order of the day, because because the way the demand for this products are going up, and not enough supply available, and with the economy, if economy picks up, this crude oil price is going to go up substantially. And at that point of time, if those companies which have already hedged their their requirement, they will be reaping the benefit. At this juncture, I would also like to share another interesting article which has been published by a Marketers Energy Advisor. This particular article is titled "The State of Airline Fuel Hedging and Risk Management in 2013." So, this particular report I'm not going to share with you all, because this website requires companies people to freely register with this website, and they'll be able to send the this information. So this is another well documented article which gives an indication or which very clearly indicates the survey findings which Marketers Energy Advisors have done with major commercial airlines of all over the world. And as part of this survey finding, they have identified how to company measure the benefit of the hedge. So keeping the discussion about Air India in mind, when with respect to hedging the price risk, when crude oil was quoting at 110, and in the hindsight comparing its hedging performance with respect to crude oil at $45, somebody may say that this company has taken a wrong policy, but that is not what that is not what the views of companies. Many companies have very clearly expressed their views that stabilizing the cash flow, knowing what is going to be their cost of operation, is of paramount importance to them, rather than paying a higher price for their input cost. This particular document also shows what are the different instruments which these companies have used to mitigate their ETF risk, to what extent of the requirement, commodity requirement, ETF requirement they have hedged, and to what duration this companies have hedged. And most of the this report shows most of the companies have gone for a hedging which is ranging from 17 to 24 months. So when I was searching about Indian Airlines hedging policy, I came across an article which has mentioned that they have gone ahead and hedged the ETF price for 5 years. So how authentic is that report? I'm not sure. So if at all, if they have done, in my view, I felt that 5 years probably is a too long a duration to take a call on future price movement. Maybe a company, whoever is interested to do a hedging, take a hedging decision, maybe can go for a little lesser duration, maybe 15 to 18 months, and revisit the hedging decision at a later point of time, so that in case if they are at the wrong side of the hedging decision, they will be able to take the corrective action. So because predicting a commodity price for too much into future could be a little difficult, and specifically when it is with crude oil and derivative products of the crude oil, and the source of risk or source of variability can come from any source, and predicting or identifying or forecasting those sources could be a very difficult proposition. So with this, we will be ending this session, and we will be discussing more about how companies can use these forward contracts, different kinds of different kinds of derivative, exchange traded derivative contracts as well as forward contracts to mitigate the crude oil price risk as well as the refined product price risk in the next session. So thanking all of you, and I hope you had a good session understanding what companies do to mitigate their commodity price risk. So with this, I will be winding up this session and looking forward to meeting you all again in the next session. Thank you, all of you.